It's the morning after the US election. Trump's obviously won, and the equity markets are on fire, at least in America. The market believes Trump is an anti-inflation president, which I totally disagree with.
Equity markets are up based on optimism for tax cuts, optimism for more M&A. There's a lot of M&A that's pending, lower taxes, a higher growth. All of that is positive for the equity market. At the same time, the bond market is down. Bond markets are down because of higher growth, because of concern about higher inflation in my mind, and certainly concern about higher deficits.
All right, so today on the pod, I'm excited to welcome veteran money manager Adrian Day. Originally from London and currently living in Puerto Rico, Adrian attended the London School of Economics, one of the world's leading institutions in finance and economics. But what I particularly enjoy about Adrian's approach to the markets is he's a long-term thinker. So things like an election in the US doesn't necessarily create a knee-jerk reaction to his investing philosophy. He has fantastic global perspective, a tendency to always incorporate gold and commodity-related investments, which we like here at Pinnacle. And he and his team search global equity markets for companies trading less than their intrinsic value and for companies that they believe they can hold for a long period of time. In short, his macro outlook on the markets and global economy, in my view, is amongst the best. So, Adrian, welcome to the pod.
Well, thank you very much, Aaron. I couldn't have said it better myself.
Welcome. So today, and for the last 30 years or so, you've been the CEO, obviously, of Adrian Day Asset Management, and your firm has sort of a high-level vision of, conservative management in speculative markets. Explain just briefly to our audience, what that means and the types of investments that you guys seek out.
Sure. No, that's a good question and an interesting point, because a lot of people, when they think of speculative investments, they immediately think of very sort of short-term or frantic trading. And that's not what I think of by speculative. What we're looking for is, high-quality companies. We can discuss what that means, but high-quality companies with obviously that means good management, good balance sheet, but with a sensible business plan and the ability to execute on that business plan. Might take years, and that could be large cap companies, or it could be tiny companies, micro caps. The same principles apply. But it could take a long time for those things to come to fruition. And so when we think of a speculative, when I say conservative management in speculative markets, we may be thinking of a company, again, with a good business plan that might take years to come to fruition. We're not looking at frantic trading. We're not looking at, very, very short-term, events-driven, catalyst-driven investments. If we're looking at exploration, for gold mining exploration or any resource exploration, by its nature, if it's a small company, I'm not talking about Freeport doing exploration.
Right.
But if it's an exploration company, by its nature, that is high risk, by its nature. Right? Can't get around that. So for us, when I say conservative management in speculative markets, how do we limit that risk? So one of the things we look for might be prospect generators. It might be companies with access to capital outside of having to go to the always problematic and always volatile and uncertain equity markets. And so a company like Origin, for example, has over $21 million Canadian in cash. For their current business model, they're never going to need to spend that much money. The only way they spend that money is if they find a royalty that they actually want to buy, which may well happen. I'm not saying it won't happen. So a company like that, you can say is conservative, and there's a lot more to talk about the company. I'm just giving it as an example. Because they don't have to go back to the equity markets, we look on that as a conservative way to get exposure to exploration.
You're not looking to capitalize on kind of the explorers that are going out and trying to make a discovery through the drill bit. You're more looking at prospect generator models when it comes to the pre-production type deals or pre-development.
Sure. Now, and no, absolutely. I would qualify that by saying I'm not looking for the exploration company looking to make a discovery, a one project exploration company looking to make a discovery.
To me, I invest in a lot of junior resource companies. I'm certainly not as let's say conservative as you, and that probably costs me a lot more than it does you. But I get excited by the opportunity to like nothing pays like discovery, as Rick Rule says, right? I always looked at prospect generators as boring and not tons of upside.
Yeah, no, that's a fair criticism. And the traditional prospect generator model has not really worked that well in the last few years. Because the truth is, you still have the risk. They still have to make a discovery. I liken a prospect generator to, small pieces of several lottery tickets as opposed to one lottery ticket.
Right.
But you've still got a lottery ticket. You still have to win. You still have to make the discovery.
It just kind of spreads the risk around if you get into the right prospect generator, I suppose. Still gives you the upside though of a discovery. I get it.
One thing I will say, you said you get nothing excites you like a good discovery. This sounds weird because it's not an excitement of the moment. It's an excitement over time, but nothing excites me like finding a really good quality company, and that means good management, good balance sheet, good business plan, good execution, a really high quality company that we can hold. And so, for example, the first two stocks we actually bought back in March of 1991, one was Nestle and one was Franco-Nevada. Now, Franco, as you know, merged with Newmont and then spun out, but let's just ignore that difficulty for a moment. We have not sold those shares. If clients were with us in 1991, we still own those shares.
Wow.
And that gets me really excited.
That's incredible.
Now, if you can then find a similar quality, but you can hold for a long time with a small cap, then I get even much more excited.
How do you, like a Nestle, for example, how do you not want to sell that and put the capital to work elsewhere after 10, 15, 20 years? You still see intrinsic value? Is that it? Or?
Sure. I mean, anytime you sell something, as Rick Rule likes to say, three bad things happen. One is you pay the tax man, one is you pay the broker, and three, you've got to find something else to do with the money. Now, when I look at a company like Nestle, and the fact that we hold it for a long time doesn't mean that I'm not constantly reevaluating. Right now, you've got a dividend of about 3.6% in Swiss francs. You've got a company that for at least 50 years has increased their dividend every year for 50 years and has never had a reduction in their income over that period of time. So if they can continue to grow and continue to increase the dividend, I have to ask myself, why do I want to sell this?
I like it. I like getting into the nitty gritty on the investing philosophies. I want to go a little bit more macro.
Okay.
So I think the timing of the pod couldn't be better in my view. It's the morning after the U.S. election. Trump's obviously won. Looks like they got the Senate and potentially the House, and the equity markets are on fire today, at least in America. So on the flip side, commodities like gold and copper are down significantly. To me, this is maybe I think it's a knee-jerk reaction, but this signals that the market believes Trump is an anti-inflation president, which I totally disagree with. He's going to help get rid of inflation. That's that's my sense, judging by how commodities are trading. So do you think the markets have it wrong in that regard? What are your thoughts on Trump's potential impact on the U.S. economy and fiscal policy?
I don't think gold is down because of inflation, incidentally, but maybe I'm wrong now. I mean, in many ways, I think the reactions of the markets in the U.S. are logical. And Mohammed Al-Aryan this morning was on Bloomberg, and he made a big point, how the reactions are all logical. Now, I'll explain that. Equity markets are up based on optimism for tax cuts, optimism for more M&A. There's a lot of M&A that's pending.
Mm-hmm.
I sincerely hope, we expect he'll get rid of the chairwoman at the FCC, and that'll make mergers easier, lower taxes, a higher growth. All of
Right.
that is positive for the equity market. At the same time, the bond market is down. Bond markets are down because of higher growth, because of concern about higher inflation, in my mind, and certainly concern about higher deficits. Now, the reality is deficits have been going up like crazy for decades in the US, and the amount they went up under Biden dwarfed what they went up under Trump, which dwarfed what they went up under Obama, and so on. And they would have gone up. They would have continued to go up. They will continue. They would have continued to go up, whoever won the election, in my view. But I think Trump perhaps is seen as less concerned about deficits, especially recently. Most Republicans in the U.S. have only been concerned, it's a criminal in my view, but they've only been concerned about deficits when there's a Democrat in the White House. When it's Bush or Trump, well, deficits are good. And you can argue there was 9/11 that wasn't Bush's fault, that cost a lot of money. You can argue that COVID came along, which cost a lot of money. So, you can make these arguments. I'm sure a Democrat could make arguments on the other side. I'm just saying that Republicans seem much more concerned about deficits when Chris in the White House. With Trump in the White House, you're likely to see less pushback on deficit spending. So anyway, bonds are down because of higher deficits, higher growth, and I think concern about higher inflation that comes from higher deficits. So why are the metals down? Well, the metals are down because you've just seen bonds down, stocks up. So, risk on. Do we want gold so much in that kind of environment? High growth, high equity markets, happy days are here again kind of thing. I've seen all sorts of memes this morning about Trump with the sun rising in the background, as we saw with Reagan back in 1980. So in that scenario, and you add to that the dollar, of course, which jumped this morning, overnight and this morning, the dollar was up strongly. So that on the surface is a negative environment for gold. I think also, and I was having dinner with a friend here in Puerto Rico last night, and we were talking about, there's always this, after you've had a strong move, there's always this sort of pent-up desire. People are trigger happy, ready to take their profits. They don't want to see these profits go away again. This was an example. People are ready to take profits. Something happens, gold's down, let's sell. And I mean, I've even had clients this morning say, they want to sell all their gold stocks or half their gold stocks, while they still got profits.
Right.
Spent the morning trying to talk them out of it. So I think it's logical why gold is down this morning. It's a pretty huge drop. Maybe it's overdone, but, these things are always overdone after you've had a very strong move up without any kind of pullback. You haven't had the pressure being taken out on a repeated, constant basis. So you had a lot of loose holders, I think. In my view, this is very, very short term. And maybe this is more, when I say very short term, it might be a week or two or three. There's always some follow through. But in my view, this is not a change in direction for gold by any means. This is not the end of a bull market by any means. So why do I say that? Well, all of the factors that have been driving gold for the last 2 years, including the most recent factors in the last couple of months, getting US, North American and European people beginning to move back into gold, they're still intact. Central banks have been the number one buyer of gold, and their concern is the weaponization of dollar. Is that going to change under President Trump?
No.
I don't think so. He's threatening even worse. And of course, there's nothing to get some of these countries to sort of speed up their diversification out of a dollar and, working on alternate payment systems and alternate reserve systems, than the president saying, you abandon the dollar and we're going to punish you. Well, in that scenario, I would make some alternate arrangements pretty quickly. So that's not going to change. Chinese investors, Chinese consumers, the number 2 largest group buying gold, down in the last quarter, although still up on a couple of years ago, but down significantly in the last quarter. But their economy has not. Their concern about the economy and the renminbi has not changed. Their concern about the Chinese banking system has not changed. They're not pushing money into real estate. They're not allowed to buy crypto. So the desire of Chinese people to hold some gold, and as you know, when someone goes to a jewelry store in China and buys gold, it's a jewelry and an investment at the same time.
Right.
Mix of those motives is different. Unlike in the US, it's very clear you're buying a gold ring or you're buying a gold bar. It's not a mix. So I don't think that's gone away. And then when you look at the Western investor that's concerned with the macroeconomic environment, let's say, well, you've got higher deficits coming. I suspect you're going to see higher inflation. I just don't see how inflation is going to go down under Trump, personally, unless we go into a depression, which I'm not expecting. So higher deficits, stubborn, rising inflation, and the Fed is going to continue to cut rates because the Fed's motives for cutting rates in my view, are as much to do with the cost of service in the U.S. debt as they are to do with unemployment. Yeah. If your big concern at the Fed was unemployment, you could easily have not cut rates 2 weeks ago.
Yeah.
The new jobs numbers were better than expected. I'm skeptical of a lot of the numbers. You can look under the hood and see things quite as strong as they appear. But the Fed could, if that was their major one concern, right? We want to get inflation down. It's not quite down yet. Oh my gosh, look at unemployment. Ticked up, 0.1%? They could have held off cutting rates. I think they want to cut rates because of a budget deficit and the cost of service and the debt, frankly.
Absolutely.
And so none of that's, sorry, this is a really long answer. I'm sorry.
No, it's good, Adrian. I'm loving it. Keep going.
My point is none of that has gone away. None of that is changing. Some of it is potentially even getting worse. And so, this correction in gold, you rarely have a one-day decline like this with a bounce back the next day. So we may get a bit of follow through. I suspect we will. We'll get follow through in the stocks, I'm sure. A month from now, I think we'll be turning back up again.
I'm in the same camp. I think it's important to remember as well that with Trump's first term, I think gold averaged somewhere in a 12 to 14% annual return on average during his 4 years on his first term. So, we called him the inflation president back in 2016, and I think he'll be the same this second term. Now, you touched on China. I want to dabble into that conversation a little bit. You have obviously great global perspective. It's been a massive driver of commodity prices over the past decades, but it has its economic challenges now, not the least of which is its demographics. With the Trump presidency, does that make things worse for China? And as a result, worse for, things like base metal commodity demands like copper and so forth? Like, is there any impact on China from this election? And how should an investor approach commodities?
That's a good question.
Trade?
So first of all, put the election aside for a second. But first of all, you're absolutely right. China's economy is weak, both for cyclical issues, but also for secular issues, prime of which is the demographics that you mentioned. So President Xi has made some ridiculous economic and monetary mistakes, which come from his, he would be happy under Chairman Mao, I think.
Yeah, I agree.
He's not Dao Xiaoping. But anyway, so he's made some really bad economic and monetary mistakes. But even if you rectify those, which of course they can do, you've still got the secular issues, prime of which is the demographics, which is, the one-child policy is now really beginning to bite. They don't have enough working people to take care of the older people. And that's only going to get worse over the next 5 or 10 years. And that's apart from any social problems that you have from a lot of single young men flooding cities because there's no employment in the countryside. Yeah. So you've got a lot of unemployed single young men. Not a good scenario for social peace. But so, I think there's some things that they can do, but they've still got their fundamental issue. Now, the economic dependence on selling cheap stuff to the United States is a lot less than it was 10 years ago. They're selling much more to other countries, and the U.S. is importing more from whether it's Vietnam, Thailand, and other regional areas where, of course, a lot of U.S. and global manufacturers, because of Chinese costs going up, have outsourced from China to places like Vietnam and Cambodia that are less expensive. So China's economy is less dependent now than it was on simply selling cheap things to the US. But still, it's a significant part of their economy, and an aggressive tariff policy, particularly if it was targeted at China, would have a negative effect on the economy, no doubt. Because you've got things like chips and, it's not just plastic Christmas tree ornaments anymore.
Right.
But of course, a lot of rare metals, as we know, the only places that refine them, the metals themselves aren't so rare, but the only place that's really refining them is China. So they still have to get something from China. So, I mean, I think this will be a negative. I don't think it'll be as big a negative as 10 years ago or 8 years ago under the first presidency.
Now, I'm just going to jump a little bit of a sidetrack, but it's interesting because we chatted about it. I want to get your take. So we talk about demographics in China. They're not good. But when I look at places like North America, even Western Europe, but let's stick to North America, our fertility rate is crashing. It's at an all-time low. I'm a long-term investor too, and this is constantly on my mind. How do you take a long-term investing approach on things like hard assets when fertility rates are collapsing? Everybody's response to me is, well, you have immigration. Canada and the US will have immigration. But eventually, does the immigration not run out? Are you concerned, to summarize very clearly, are you concerned with the demographics, the crashing fertility rate in North America? Does it change how you invest within the continent?
It's a good question and a big one. I am very, very concerned about crashing demographics in North America and in Europe, which is even worse.
Yeah.
For a lot of reasons. One reason is just for social reasons, because you see what's happening in Europe, where how can I put this politely? I mean, the identity of the culture is simply changing.
Yep.
Because the native people are having fewer and fewer babies, children, and being replaced by people from other cultures. Now, in the case of North America, in the case of the United States in particular, most of our immigration has come from Mexico and Latin America, where the culture is, broadly similar, to the native culture of North America, which has always been a melting pot anyway. Unlike, say, in Europe, where you've got a completely different identity and culture. So I think it's true to say that, from an economic point of view, yes, society is changing, but immigration can take care of a lot of that. Will immigration be cut back under Trump? Certainly the illegal immigration will, we hope, should be, if I may make a political comment. So I would expect, we would expect certainly lower immigration numbers, both legal and illegal, Trump, than we have seen for the last few years. But when you're looking at commodities, gold and other commodities, the population of the world is continuing to increase. And so as big countries like, say, Brazil and Indonesia, as they start to, and India, of course, as they start to, from their current situations into a bigger middle class, you're going to continue to get demand for metals of all type. You look at India, you look at Indonesia. It seems to me that pretty much everyone seems to have a television, but an awful lot of people don't have a refrigerator. They don't have inside toilets. They don't have automobiles. So slowly people are going from the push bike, pedal bike, bicycle, whatever, to motorbikes, and then moving up into automobiles. And as those economies develop, then all of these things that we take for granted, like cars and refrigerators, are going to be more widespread, and they just use an awful lot of metals, as we know. The demographic collapse is a huge concern for many reasons, but I don't think it's a concern, certainly not, for the foreseeable future in terms of metal consumption.
What about things like land and real estate values in North America, particularly?
You'll still have people wanting 2 houses and 3 houses. You still have demand for property. I'm not sure that I see demand for land going down in the near term just because of the demographics. You might have, if there's strict controls on immigration, I'm just saying if, I'm not saying it's good.
Yeah.
But, if the numbers coming in drop dramatically, then you would have an impact on things like apartment complexes and multifamily housing and so on.
Right.
But that could make a single-family housing more affordable, which might mean a lot of the 30 and 35-year-olds that are still staying, living with their parents might be able to actually afford a house and move out.
Good point.
Yeah, I don't think so I think there'll be some changes between types of property, but I'm not sure that land itself or property in the broadest possible sense will be slammed.
Okay, well, I want to wrap it up with, this might be a tough question, but I want to put you on the hot seat here because I know you probably have more than one, but twofold question. If you could only pick one commodity and one market, any market in the world, which commodity are you most bullish on over a 3 to 5 year period? And which market are you most bullish on over a 3 to 5 year period?
Okay, the first one is easier to answer than the second. And when I say more bullish, I'm going to change your question slightly to say better risk reward.
Good.
Because there might be something that I think has high potential, but at a higher risk. So if I'm looking at the most bullish market out with the least amount of risk, it's gold without a shadow of doubt. There are environments I can think of where copper will do badly or uranium might do badly, even though I'm bullish on those. But the scenario where gold will do badly over a 3 to 5 year period means that the U.S. kisses and makes up with China, Russia, and Saudi Arabia and all the other countries that are involved in the BRICS. It means that the United States and other major developed countries all start running budget surpluses in the near term. It's just not going to happen. So gold, to me, is very difficult to think of a realistic scenario where gold will not do well. So gold would be the answer to that. As regard markets, right now, to be honest, we are being much more bottom-up and on an idiosyncratic basis, on a one by one basis than I have been for a long time. I mean, we always look top-down and bottom-up. Sometimes the top-down just is so compelling, it just drives investment opportunities. I think there's a lot of opportunities in the British stock market right now, and I say that not because I'm British, but I don't know that I want to be holding for 5 years because the government over there can do a lot of harm. But in the near term, that market is oversold, and you've got some really good companies with good dividends, low valuations. I mean, you can get 5-6% dividends on good quality companies, particularly if you're looking at the exporters. But I'm not sure I would, I'm not sure there's any market, frankly, I want to hold for
Interesting.
For 3 to 5 years. Which is contrary to the way I normally think about markets.
Yeah.
I mean, I could say Switzerland. That will be a cop-out just because it's such a low-risk market, and Nestle, of course, is the largest component of that market. But that's a cop-out. If I had to buy one market and I couldn't sell it for 5 years, it would probably be Singapore. You've got good quality companies. But Chinese stocks, Hong Kong, China stocks are cheaper, but they have a lot more risk.
I think to your point, like I look at China and I just want to buy. I want to buy a bunch of names in China. But to your point earlier, Xi just scares me. He is a communist through and through, no pragmatism, and so I just worry about what policy next will he come up with that is anti-business, anti-growth, right?
Sure. And that's apart from Taiwan.
Yeah, exactly.
Which is a big elephant in the room because he really wants to get that done before he leaves office. And if I were him, I would do it before Trump comes in, frankly.
Yeah.
Um, but yeah, I agree with you. I mean, we've had a lot of Hong Kong stocks for a period of time. I don't buy stocks. I don't buy Chinese stocks unless they trade on Hong Kong, and more of them do now. But so, I say Hong Kong, China, but I always buy on the Hong Kong market. We've had a lot of those stocks for the last couple of years because the valuations are just so compelling. But, if it's a Warren Buffett test to buy something that you're happy buying, knowing that the market's going to be closed for the next 5 years and you can't sell, I don't think so.
Adrian, I think that's a great spot to wrap it up. Thank you so much for joining. Where can our viewers find more of your content, learn more about Adrian Day Asset Management, and so forth?
The best place to go is adrianday.com, and we do have a newsletter which is separate from the money management, which we talk about. It'll also take you to the money management, where we have a lot of, as you say, a lot of articles, a lot of interviews.
Perfect. We'll include all those links in the description. Again, Adrian, thanks for taking time out of your day. I do very much appreciate it. This was a great chat.
No, this was great. I really appreciate it. Thank you.